Good evening and welcome to tonight's webinar where we look at member-only content for ASX investment opportunities in review. The advice provided this evening is general advice only. Investor Signals provides a broking account service which incorporates the model portfolios up on screen there. The tracking of the algorithm models over the last 5 years. This is taking all buy signals, entering on the first buy, exiting on the first sell, delivered the returns. ASX 100 14.8, US S&P 100 19.29. The 12-month year to date at 30 June is extremely strong. We'll see those numbers reviewed at the end of September. If you'd like to know more about the broking account service or the algorithm technology, please call me on 1300 614 002. The products that Investor Signals provides includes a subscription service to our research, a broking account or a private client account in your name, or access to our managed fund. For clients joining us for the first time this evening as part of your 30-day free trial, just a reminder, at the end of your trial you can subscribe to become a member for $1,320. If you'd like any tuition or guidance on how to use the technology during your trial, again please contact me on the 1300 number. Starting this evening with what is a important development in markets, and it's best classified as simply a risk-off environment that is developing. You're seeing the US dollar strengthen, and you're seeing risk assets start to retrace. And now, whether that's from Bitcoin to Alphabet, Microsoft, across the board, we're seeing obviously big corrections in commodities. Oil maybe being or is the exception there. Certainly in the metals complex, in some of the housing supplies, as I've spoken about previously, with lumber prices correcting. So there's a bit of a cascading correction under the surface, but the larger equity indices have largely held up well because of the strength of looking and thinking about the US market as the leading indicator, the strength in a narrow number of market leaders and companies that take up a large percentage of the equity indexes. What we're starting to see at the moment is what is potentially the first sign of worry, and I don't think this is not a rush for the exit. This is just a reality check of what I suggest: going through your portfolio, locking in profits, cutting position sizes where you can, and just having to think about asset allocations. And it may turn out that the market reverses from these lows or from this sell-off, as we've seen many times over the course of the last 12 months. But it doesn't pay just to assume that that's going to be a repeating pattern forever, and we're getting into a level where valuations are rich, and we've got some level of deterioration at a macro view or a macro data point. We're seeing softer employment numbers in the US, albeit from strong levels. We're seeing a pickup in risk to do with China, in particular Evergrande Property Group, which I've posted a little about on the blog, which I'm sure you've read in the media. And on top of that, you've got your third quarter earnings coming through at September, and will those third quarter earnings be softer than the June quarter? And I think they probably will be. If nothing else, if you just factor in lower commodity prices, it should translate through to lower average earnings for the S&P 500. We're seeing some of the early warning signs out of the technologies company, and not that many of them reported yet, but we've seen Oracle miss results slightly, higher costs in their cloud computing business. So whether that's a precursor to, I think, even at a conservative view, to form a view that earnings are unlikely to be higher than where they were in September. Then on top of that, we obviously have the Federal Reserve providing their pathway to reduce their bond buying program and withdraw liquidity from the market. So there's a few headwinds there that I think lay the foundations, just not to assume that this is another buy on the dip opportunity. But as always, we have to overlay a strategy around that, or a way of managing the risk of the unknown in the markets. For the purpose of tonight's presentation, what we're focusing on is this is the Nasdaq Index. It's below the 10-day average. It's come off the high. It had a rally back for a day or two, and then it's rolled over again on Friday night. Futures are down at the moment. So we're well below, in the case of the Nasdaq, say 15,200 points roughly, which was the high of Thursday night. So if we were to see the Nasdaq reverse back up through that, we're clearly back into a risk-on mode. If we do get a correction, it'll get down to a level where value presents, and we're happy to start being aggressive on the buy side again. But for right at the moment, the focus is the market's rolled over. It's trading below the 10-day average there in the Nasdaq. If we look at the S&P 500, the same thing. We've had a sell-off, a small bounce back. The market's ran into resistance, closed on its lows Friday. Futures are down at the moment. So that's the beginning of a risk-off development in the market, especially when you tie it in with the fundamental news flow and macro data, whether it be, as I said, China, S&P 500 earnings, or Fed policy changes that are coming through the pipeline. So S&P 500 below the 10-day average on the lows, as is the XJO. The XJO has been very pronounced because of a sell-off in iron ore prices. If you're not aware, iron ore traded at $90 a tonne today, down from $220 a tonne in May earlier this year. Does that mean that Fortescue, Rio, BHP are screaming buys at the moment? Well, I think if you don't own them, adding some exposure to one or two select names and keeping the position size small is something that makes sense, because obviously no one really knows where that support level is for iron ore. China's indicating that steel production should be kept at the same levels of 2020. The market is particularly worried at the moment around the ramifications of a potential slowdown in the Chinese property market or housing market, which is much greater than the market maybe originally planned for, which is why we've seen the correction in iron ore so abrupt. And we'll look at the charts for the major iron ore producers and talk about the levels as we go through tonight. But the message from these three indices that we've just reviewed at the moment really is that the market is showing the signs of the risk-off sentiment that's beginning to develop, and you should be taking some action in your portfolio. Now, in client accounts, we've taken profit on positions, we've halved exposure to other winning trades, and built up our cash position and added some inverse ETFs, which we'll look at once we finish going through tonight's stocks. One of the other messages this evening is, in times like this, you want to be shifting towards quality. So you want to be owning sort of the better balance sheets within the market, again, just as a risk management process. So tonight I'm going to focus on the ASX top 50 and spend most of the time talking about, within the top 50, which companies we're comfortable continuing to have exposure to, which ones we've maybe trimmed gains on, and then we'll finish tonight with just a look at these inverse ETFs. So clicking on watch list, selecting ASX top 50, we'll get the percentage gains to the top, shift the buys to the top. So I'll get part of the way through this list and it'll shift from buy signal into sell. I'll highlight that. We'll have a look at some of the stocks on the short side as well. Under buy signals at the moment, we got GPT. Now, preference here within the property space, as I've repeated a number of times over the last 6 months, is really the SLF. So owning an ETF that gives you a basket trade to the property sector rather than owning too many individual names. For the time being, we're comfortable with holding the SLF or the equivalent of it, and we haven't yet added a big exposure to the individual names. But GPT does sit in the top 50 model portfolio and it's continuing to perform very well. Coles has now shifted from sell signals back into buy conditions. If you don't hold this in the portfolio, you can see the range there. I think maybe adding it around this $17. All the positions in the market, you really have to take a view that any new position that you're building, the position size is kept small. On a lot of these opportunities, I'm creating a fairly wide band in the way that I'm thinking about my entry point into the stocks, and it really is about managing a small position size here and having capacity to add to it at lower levels if we were to see volatility really pick up in markets, and obviously making sure you're buying. Coles we're pretty comfortable with. We think it's unlikely that interest rates really spike and that becomes the story that derails the market. It's probably more likely to be just growth is a little slower than analysts have been forecasting. So Coles a buy on the dip there. Think about adding that. Woolworths, not if we backtrack the original switch from sell conditions into buy conditions here at Woolworths at $34. So we haven't seen a correction deep enough yet to trigger a new algorithm buy signal. But Woolworths and Coles, I'm comfortable buying these on the dip. We are starting to see the signs of commentary out of the companies just in regards to the increased spending on technology and costs relating towards moving to a more of a streamlined e-commerce home delivery model, and we're yet to see that really impact reported profit results, but maybe there's some expectation that maybe the next 6 or 12 months obviously won't see the same growth that we've seen over the last 6 or 12 months, so you need to sort of keep your expectations relatively low there. Wesfarmers, obviously highly impacted by the current COVID-related shutdowns in New South Wales, Victoria. Again, I've created a wide band here on Wesfarmers to say adding some at around this $55, $56 level, but being prepared for a broader correction and a deeper sell-off is possible. The other way to obviously approach this is to simply run a stop loss on a break below that 55.50 level, and then if we were to see it down at that lower support level, then think about adding it back into portfolios. Wesfarmers is a very strong business and likely to be a leader in e-commerce across the different platforms, across Bunnings, Officeworks, Catch, and yet to be finalised API, which is Australian Pharmaceuticals, that they're making a takeover bid for. So Wesfarmers has an attractive growth platform over the next 5 to 10 years, and buying that on a dip I think serves well for long-term investors. Mirvac under buy conditions, again preference SLF. Insurance Australia, so this is a new shift from sell conditions into buy. This is a stock that I've suggested that we're likely to see an improvement in the fundamental picture over the next 12 months. What we're looking at here is the potential of this base pattern here breaking out into a higher high. We'd like to see buying interest come in and build a support or a higher low formation above this $4.50, but I think Insurance Australia is one that you can think about adding to your portfolio. Just keep the position size small. Stocklands, again, preference still remains SLF rather than a large number of these REITs in portfolios, but you do find SLF in our top 50 model. Northern Star Resources, comfortable with some gold exposure to portfolios. Northern Star remains our preferred option. As US dollars pushed higher, gold's pulled back from 1800 to 1750, so we're seeing a little bit of weakness there in gold. Cochlear, still the healthcare space is an area that's attractive, and Cochlear we're comfortable holding that in portfolios at the moment. Sydney Airports, we've seen the increased takeover bid there and the recommendation from the board to accept the offer, so I think we'll see Sydney Airports soon the acquisition finalised there. Horizon, again, like IAG, this is a new switch from sort of sell conditions into buy, adding a small amount of this. If we look at the expectations of earnings Horizon over the next 12 months, they're relatively flat. So really for this point in time is a dividend contributor to portfolios. We'd like to see this higher low formation hold it around here, and over the next 6 to 12 months it'll be interesting to see if we see that begin to develop into a new uptrend. Tabcorp under buy conditions. We had an index rebalance in the S&P constituents for the ASX 50, and we've seen a couple of new names added into the top 50 index. Tabcorp, the pending split of the business underpins the downside risks a little, but as I've mentioned in prior weeks, we don't really see it maybe underpins the downside risk slightly, but it doesn't really unlock a whole lot of new value for shareholders, we think. Commonwealth Bank. So this is one of the rare times that a stock under buy conditions I've put in a resistance level. So we've seen the correction in iron ore prices. If the market was to continue with a risk-off sentiment, we would likely see further correction in the banks. Now, Commonwealth Bank trades at a large premium to global banking peers, and for that reason I've just put a resistance line in there at around that 103 level, and I've taken a little bit of a cautious stance on CBA until we see it trade back up through that 103 level, so you can have a think about how that might impact your portfolio. ANZ Bank likely to maybe find support down around this $25. Now, we haven't added a big position in these banking stocks, and we cut the BNKS, which was the global banks ETF, a few weeks back. We've taken profit on the MVB. So we've really trimmed down the banking exposure at the moment, which is all part of sort of this concern about what the risk-off move in markets really look like. South 32 under buy conditions, support there at around 275. Comfortable with that, so we haven't adjusted the position too much there. Treasury Wines under buy conditions, pretty comfortable with them. We've kept that position largely the same. Afterpay under buy conditions, obviously got the merger with Square, or the takeover by Square. Computershare and Link continue to like these businesses, but they're not immune, especially Computershare, not immune to the risk off or a pickup in volatility, and seeing Computershare back on that support there around $15. But generally the stocks perform very well from switching from sell conditions into buy at around $12 and trading much higher. So happy to have a look at Computershare on the next deeper pullback and the buy conditions. Westpac Bank rolling over, looking like it's going to come back down and test the $24 support again. We've kept the position size very small there. Goodman Group still remains our preferred property trust, and this is one that if you don't own, or maybe you've owned it and you've taken profit on it, any weakness that we see coming up over the coming weeks or months, should it eventuate, we'd like to see this trigger a new algorithm buy signal, and you'd certainly be looking to add to that position and build it as an overweight position in your portfolio. Woodside Petroleum remains our preferred energy exposure, and our expectation is that oil holds up at these stronger price points, and that should bode well for Woodside finding support where it is there. ResMed taking profit up here and just being patient, waiting for a deeper pullback and a shift to algorithm, or not a shift, but a new round of algorithm buy signals. So a little like Goodman Group in the property space, ResMed's a real clear leader within the healthcare space, and buying this on the next algorithm buy signal would be something that we'll certainly focus on in future recordings, but a little expensive where it is at the moment due to the obviously lead that they've had with one of their major competitors' products being recalled. Aristocrat Leisure, one of the better performing stocks in the model portfolio, originally switched from sells into buy down here at $30, now pushing $45. Don't expect the downside to be too great there in Aristocrat. Santos under buy, so preference Woodside, but also think about Santos or even the fuel ETF if you want exposure to large US energy plays. Obviously aware that Santos is proceeding, although the Oil Search shareholders still need to vote on it, but the Oil Search board's recommended the deal. Lendlease under algorithm buy signals, tough environment for them at the moment. We would look to On a 2 to 3 year outlook, I wouldn't be surprised to see Lendlease much stronger than where it is today. But right at the moment, I think with volatility picking up, there's some risks there around, the broader market, which will impact Lendlease. Macquarie Group outperformed the banks. If we think about our position going back a few months ago, it was that Macquarie was going to deliver the growth relative to the banks. It did that. The earnings outlook for Macquarie is they're not guiding towards much in the way of earnings growth. This little rally that we had over the last week or two was really allaying fears that the second half earnings were going to be materially slower or softer than the first half. And Macquarie's come out and reiterated that that those forward earnings over the next 6 months are going to only be down marginally, and that caused the rally there. But on a 12-month basis, Macquarie is likely to deliver flat earnings at best. So we're getting up to levels where I think Macquarie's, you could even think about taking profit in that for the moment. Rio, so these iron ore stocks, have we seen enough? That's the correction in Rio from 140 down to 95. Is it time? Well, if you don't own it, I do think that it's an opportunity to add small exposure. Keep your position sizes small and be prepared to add to the position at lower levels. Could we see Rio back at the levels that we saw in 2015, 2016? I haven't drawn the exact comparison, but back then iron ore was probably more around that $60 range, $70 range. We now finished at $90 today. So if we saw iron ore maybe back at $50, $60, yes, Rio would be back down anywhere from $60 to $70 itself. When you look at commodities, iron ore's corrected from 220, clearly elevated levels. The anticipation was that it would find some buying support at around that $130 to $150 a tonne. We're now down at 90. Do we see it down even further? Well, yes, is possible, but accumulating the stock at this level and having the ability to add to the position if need be. Now, if you don't want to do that, the other way to approach it is to simply be patient and wait for the stock price to trade back above the average, or simply looking at the stochastic, buying it on a cross with the short term moving above and then running a stop loss below. So just depending whether you're running a trading or an investing portfolio, and whether you're sort of adding to positions for a longer term perspective, or seeking shorter term trading profits. But the correction in Rio, you can see there that I've flagged sort of 92, 95 where we are at the moment, and manage your position size that if we were to see it down at $80, you have capacity to add to it. Even then, you don't want to be doing that across Fortescue, Rio, BHP, mineral resources, etc. Just as we don't want to be overexposed to those property REITs, you don't want to be overexposed to the resources. A way of mitigating some of that is obviously keep the position sizes small, but the other alternative is to look at that OZR, which is the resource ETF, where averaging into that achieves a way of getting broad, a diversification through the exposure without building up too many positions in the portfolio. So Fortescue, you can see the range there is quite wide now. So how abrupt the sell-off is in iron ore, and trying to get a handle on where it's likely to find buying support. But again, adding a small amount of Fortescue if you don't own it, but being prepared to see it at lower levels if we were to see ongoing issues, especially in China, around the property market there weighing on sentiment in the short term. BHP under algorithm bias signals, again the range that I've highlighted there, say 34 to 37, keep the position sizes small. Zero, still our largest exposure within the technology stocks in the top 50. We continue to like it and happy to be a buyer of that on the dip. Transurban, so now we've shifted into stocks under sell signals. Transurban finalising the purchase of WestConnect and having to do a capital raising there, so you may want to think about what Transurban looks like, the strength of the balance sheet post that capital raising. Ramsay Healthcare, we've been comfortable with this as an income contributor to portfolios. We're starting to actually see a number of analysts upgrade their outlook to Ramsay, but it's certainly not a high growth business. Amcor, this is an interesting one where I think you'll see this shift back to algorithm buy signals over the next coming months, and at that point we'll certainly have a closer look at Amcor and look to add that back into client portfolios. CSL under sell signals, I'd like to see a deeper sell-off there and a switch back to buy conditions, and we'll add that. Suncorp we're cautious on, Medibank I'm cautious on, Telstra we're sticking with that as an income contributor, Sonic Healthcare we're cautious on it from a valuation standpoint. I think this will pull back, switch to buy conditions, and you might look to add it in on the next algorithm buy. Brambles has had a correction lower. I think we see that switch to buy conditions soon. Dexus not doing anything there. APA not doing there at the moment under sell conditions. ASX, a little like Telstra, you can think about maybe holding this as a income contributor portfolio, but I just highlight that it is under sell signals at the moment. I don't think it's quite as defensive as something like Telstra. Newcrest under sell, preference Northern Star within the gold space. National Australia Bank, I put a post on the blog today about this. We're now on the short side of NAB. Centre Group under sell signals, that's been removed from models. Origin, not chasing it, too many of these, so Origin under sell. James Hardie, I put a post on the blog today. We've got US housing data out middle of this week, which could be a little softer than the market, than previous trends, which may weigh on James Hardie, and it is trading on a high PE valuation. Qantas under sell signals. QBE risks there, and then there we are back to Endeavour. So just to finish tonight, we'll have a quick look at these ETFs, the inverse ETFs. So the bear ETF, so as long as the XJO trades below that 10-day average, and likewise with the S&P 500 and the Nasdaq, these are inverse ETFs are a consideration. So the bear, which is just, if the XJO goes down 1%, bear goes up by 1%, whereas the 2 times inverse ETF of the XJO is the BBOS. We're starting to see that move up now from $4 to $4.55. The equivalent in the US is BBUS. So if you're looking for a hedge in the US, so as long as the S&P 500 trades below that moving average, we've seen the BBUS rally up from 940 up to around 1010. So just to go back to where we started this evening and just remind you what the focus is, and I'll just use the S&P 500. So for the moment, as long as the S&P 500 closes below Thursday night's high, which was 4485, we're keeping a fairly defensive risk-off position towards portfolios. So trimming positions, shifting towards quality, and thinking about